Industrial property increased its market share by 4% since the pandemic, while office and retail declined. Let me explain why. Remember when industrial properties were the forgotten stepchild of commercial real estate? Those bland warehouses and logistics facilities never got the same love as prestigious office towers or buzzing retail centres. For most investors, industrial was an afterthought, the third best asset class at best. But then 2020 happened. Suddenly, industrial real estate went from the ignored middle child to the star pupil of commercial real estate. Practically overnight, this underdog asset class started outperforming its glitzier office and retail siblings. The question is, why? What tectonic shifts allowed industrial properties to shed their unsexy reputation and become a hot commodity for investors? More importantly, is this just a pandemic fling or an enduring love affair? I've spent the last few weeks deep diving into the data to find the answers. This is exactly what I found. As of late 2023, the total Australian commercial property market was valued at $219.7 billion. Not too shabby, right? And overall, the sector showed a resilience coming out of the pandemic. But here's the interesting part. Industrial property used to trail behind office and retail in terms of total market share. That was just a normal state of things. Except now, industrial share has actually increased by 4% since COVID hit, while office and retail have declined. Now, 4% might not sound like a massive number on the surface, but the fact that it came at the expense of the traditionally bigger asset classes, that's kind of a big deal. So what drove investors to start pumping more money into industrial real estate? But let's be real, market share alone doesn't really tell the full story here. The bigger question is, how has industrial property actually performed compared to the office and retail over the past couple of years? When you look at transaction volumes, it's pretty eye-opening. Across all commercial asset classes in Australia, transactions declined by a hefty 62% between early 2022 and 2023. Not exactly an encouraging trend, right? But here's where industrial stands out. While office deals dropped a whopping 73% and retail fell 68%, industrial transactions only declined by 63%. Not a massive difference on the surface, but it does signal industrial's relative resilience. And when you analyze pricing and returns, the gap gets even wider. Most industrial funds have actually seen positive capital growth over the last 2 years. But office and retail? Mostly negative returns for them during that stretch. The data on vacancy rates and rents adds another layer. Sure, industrial vacancies did tick up 7% recently due to new supply, but get this, availability is still over 40% lower than it was just 2 years ago and a staggering 70% below 2020 peaks. These tight markets mean landlords could hike rents aggressively. We're talking 18% year-over-year jumps for premium industrial assets. I know what you might be thinking, those performance numbers are pretty impressive, but is it just a short-term pandemic blip? Or do investors actually see industrial's momentum sustain over the long haul? Well, if you look at the data on investor sentiment, it tells a bullish story for industrial. Despite overall commercial property cooling off a bit due to interest rate hikes, industrial assets still remain hot. The nationwide vacancy rate for industrial space was just 1.1% at the end of 2023. Not only is that the lowest of any country globally, but Sydney's 0.5% availability is the lowest of any city worldwide. Crazy tight market, right? Now, gross leasing activity has slowed from those crazy 2021 peaks, but even so, demand is still running above the 10-year average rate. Tenants clearly still want to lock in quality industrial space. This constant appetite shows in the sales data too. Industrial properties represented a third of all commercial acquisition volume in Australia last year. That's a huge chunk of the pie. And investor surveys for 2024 projections reveal optimism about continued capital growth exclusively for industrial assets. But it's not just local investors piling into industrial. Offshore players have clearly recognized the opportunities as well. While only 12% of office and retail sales involved foreign capital in the first half of 2023, that number was 13% for industrial properties. And we're talking massive investments amounts here. In Q2 2023 alone, those overseas investors spent over $2.8 billion into the Australian industrial real estate sector. That $2.8 billion accounted for about 39% of the total acquisition spending that quarter. Cautious optimism is the best way to describe overall investor sentiment in commercial real estate. Declining inflation and potential rate cuts will be huge factors determining future transaction volumes, long-term asset performance, and just how strong the investor appetite remains. One trend that seems likely to sustain is continued rental growth for industrial properties, even if demand from logistics occupiers moderates somewhat down the line. The reason? E-commerce is expected to keep rising, further increasing the need for prime logistics spaces serviced by modern transport networks. Properties that can deliver on that last mile logistics capability while also aligning with investors' increasing focus on sustainability targets. Those will be the ultimate prize assets in the industrial sector going forward. So there you have it, my full analysis on how industrial real estate transformed from an overlooked afterthought to an investor darling outpacing office and retail. If you found these insights valuable, you'll definitely want to subscribe to the channel and hit that bell notification. That way, you'll always get my latest market updates and investment strategies first. Cheers, guys.